Hey everyone, in this installment with Q&A with Wall Street, I'm going to look at Symbotic, the innovative AI robotics company. So without further ado, let's jump into this question and answer session with Wall Street.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the first question comes asking about margins, profit margins. And to give you context behind this, Symbotic management saying that over the long run, their gross profit margin is going to move higher. Every year, they're likely to move it higher. Although quarter over quarter, there may be some volatility, some ups and downs. But longer term, investors can expect its gross profit margin to move higher. And the company's CFO jumping in to say that their guidance for the second quarter reflects their flexibility to accommodate increased spending if needed, as we need to accelerate deployment schedules and ensure we have a high quality deployment with as little disruption as possible. So the company saying that their profit margin might be lower in the next quarter to give itself flexibility to satisfy customer demand. If they told a customer they're going to complete deployment by a certain time with a certain level of quality, they want to meet that promise. And if they need to spend a little bit more money to meet that promise, they want to be able to do that instead of just focus on profitability. So they're balancing near-term gross profit margin with customer satisfaction here to make sure that their customer satisfaction is strong, because ultimately longer term, that's where they stand to benefit, right? They're going to need to have this land and expand strategy where you have companies that want to implement its robotics technology. But if a company, let's say for instance, has 2,000 locations, they're not going to implement Symbotic's technology in all 2000 all at once. They might do a test run of 10 locations or 5 locations or 1 location. Symbotic will need to prove itself in that 1 location and then earn a wider adoption in that business. So that's where right now is trying to focus on implementation effectiveness, because customer demand is strong right now. It needs to implement effectively in order to fulfill on this promising opportunity. But in the longer term, in terms of the longer term profitability, the CFO saying we can continue to be on a trajectory to improve, and you're going to see that start to improve in the second half of this year and year over year, continued improvement in our profitability. So like I mentioned, they've repeatedly said this, quarter over quarter there may be some volatility, but longer term, their gross profit margin and their operating profit margin is on an upward trajectory as they get better and better and better at serving their clients, at implementing this innovative robotics technology. So one of the key things that came out of their latest quarterly update was that BreakPack is now available as a standalone product. So the CEO got a question about that and saying, like, typically what you see in BreakPack is customers that are in the drugstore business, which is obviously a big, big market, right? You think of CVS, you think of Walgreens, thousands upon thousands of locations. And initially, it was built for Walmart, and Walmart has 45 drugstores within its 4,500 supercenters. So it's building the technology initially for Walmart, and if it's proven there, it can then expand to further opportunities. There's signals that it's not yet proven because the company is not selling it right now. You could see right now they say we're not actively selling that brake pack right now. As we get more comfortable with it, we'll begin to market it as an add-on product to our basic product. So there's still, even though it's a standalone product now, it's almost there, but they want to get a little bit more comfortable with it, make a few iterations perhaps before they start making it available more generally to a broader audience outside of Walmart. And if it does go out, that could be a nice incremental revenue source for Symbotic, because like the management mentions here, like the CEO mentions, it's obviously a big market. CVS and Walgreens have thousands and thousands of locations, and there are many other drugstores with thousands and thousands of locations overall in the market. So it's a huge opportunity. They want to make sure they get it right before deploying it to the mass market, rather than deploying it to the mass market and then having to bring it back and make changes later. They want to improve on it now, get it right first before deploying it. They feel that it's a more effective strategy to do it in that way rather than the other strategy where you send it out, see what doesn't work, bring it back, and then send it out again. So the next question asks about the supply chain. So the analyst is asking about adding suppliers to alleviate some of the inventory challenges, which they have had in recent years. Although very many companies have had supply chain problems, it's more acute for companies like Symbotic with innovative technology, younger companies, because when you're younger, smaller, with innovative technology that hasn't yet been proven on a mass scale, suppliers are hesitant to commit to you. By commit, I mean they're not spending on their own manufacturing capacity to serve you as a customer because you haven't proven yourself yet. So they don't want to take a big chance with you because you're younger, you haven't proven yet. So they'll kind of incrementally increase their supply for you, incrementally, flexibly add to their supply chain, but not full scale, right? And so this is what management is talking about here. But the CEO is saying that they're seeing better inventory, higher quality products coming from their suppliers, which means that they're actually pushing the suppliers to do a lot more testing in their factories as opposed to on site. So what we're seeing from suppliers now and what we're working at is suppliers now understand that we are real, how real we are. There's a lot of interest from suppliers now. They're becoming more price competitive. They're willing to invest in quality. So I think we're past the struggles to find good suppliers. That's huge, right? That alleviates what I was talking about earlier, how suppliers were hesitant at first, but now they're realizing how real Symbotic is, given the rapid increase in revenue, given the strong backlog of orders that they have, given the big investment from Walmart. So now suppliers are saying, okay, we feel comfortable in making ourselves ready to serve you as a customer. So now they're investing in quality, they're making sure they have what's available for Symbotic, and they're making improvements. They're willing to negotiate, they're willing to have discussion, and that's all great news for Symbotic. And you saw that in the latest quarter where they were able to deploy at the fastest time ever, 20 months for a deployment from Symbotic, and that signals that they're getting better accommodation from suppliers. And if that continues to improve, they can increase their time to deployment, which will lower the cost to serve customers, which will add even more incremental customers because now they won't have to wait as long for implementation, and on the positive virtuous cycle can go. So this is great news here for Symbotic and its investors. So I learned a lot here from this question and answer session with Wall Street analysts about Symbotic and its innovative robotics technology. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.